Welcome to this video on investment strategies for cryptocurrencies. This is part 1 on fundamental analysis. So what's the best investment strategy for cryptocurrency? Is there a one-size-fits-all strategy that everyone uses? Is it completely different than the strategies used in other asset classes? Well, in this video, we will explore a few of the methods that are helping individuals and institutions in the cryptocurrency asset space. So whether you're an individual trader or working for a hedge fund, this video can shed some light onto a way to improve your current cryptocurrency investing style. So investment strategies can be divided into 2 different styles. The styles are very different in practice, but overall they both attempt to calculate the value of the asset today using information that is readily available. The fundamental analysis calculates the value of an asset using both tangible and intangible data, such as price ratios and performance metrics. On the other hand, technical analysis calculates value using price and trade data. There is a long-standing battle between the users of fundamental analysis and technical analysis in the investment world. We will not attempt to tell you which one is best. Our goal in this article is simply to give you a few ideas on each so that you can improve your own trading style. So what exactly is fundamental analysis? Investopedia defines it as a method of evaluating an asset in an attempt to measure its intrinsic value by examining related economic, financial, and other qualitative and quantitative factors. Several of the wealthiest investors in the world swear by fundamental analysis as the secret to their fortunes. Have you ever heard of a guy named Warren Buffett? He's one of the richest men in the world and the best-known fundamental investor. Another very significant investor using fundamental analysis is Carl Icahn, one of Wall Street's most successful investors. Neither of these men start their investment analysis with a stock chart. No, they prefer income statements and balance sheets to analyzing stock price history. Warren Buffett attributes much of his success to the seminal book on fundamental analysis, The Intelligent Investor, by Benjamin Graham. While there isn't a similar book for cryptocurrency assets yet, there's still much to be gleaned from the methodology presented in the book. Fundamental analysis is a tool with significant history in the stock market. One of the pieces of data used are company financials, such as the income statement and balance sheet. Using these 2 items, investors can analyze price ratios, look at the company's debt, analyze the effectiveness of cash invested relative to the returns, and all sorts of things. Quarterly earnings are used as a predictor of total annual profit and thus the intrinsic value of the company today. Fundamental investors don't completely ignore stock price. They use price to calculate price-to-earnings ratios, among others. These ratios help fundamental investors compare companies in various sectors and industries. Other tools of the fundamental investor include equity analyst ratings, the industry outlook, and a number of other pieces of information beyond stock price to estimate the true value of the company. Now let's take a look at how we can use fundamental analysis in cryptocurrency. The market cap of a cryptocurrency lets you know the overall cash value of the total amount of crypto that exists. This amount is calculated by multiplying the trading price of the cryptocurrency times the total number of coins or tokens that exist. The market cap gives you a good indication of how much of the currency is in use relative to other coins and tokens. You can use it to understand the percent of the coin that is owned by the creators or any other ownership blocks that might influence the future price. One of the most simple yet profound pieces of advice from Warren Buffett is to invest in things you know. Well, one of the best tools you can use to know a cryptocurrency is the white paper. There's so much information in a white paper that it should not be overlooked. The white paper typically provides a history of the cryptocurrency. It explains its reason for existing and what problems it solves. It explains the way revenue will be produced. It explains the volume of the currency that will be released in rich stages, and then provides information on the management team. It's important to have an idea of the use for the cryptocurrency. Does it solve a real problem? Does the industry it improves acknowledge the existence of said problem and want to actually fix it? The answer to that question will give you an idea of the likelihood of adoption or the actual usage of the coin or token. ERC20 utility tokens allow the buyer to invest in a token, not a company. Security tokens derive their value from a company's value or some external tradable asset. Security tokens can even represent an equity stake in a company. As such, they require a different set of questions for fundamental analysis. How would the asset create revenue? That future revenue gives the fundamental investor an idea of how to value the token today using the present value of the future expected revenue. To calculate this, investors use a discounted cash flow model. Investors discount the annual profits of the company by a discount rate that accounts for their desired return on capital. After discounting each year's profits, investors add up the sum of all future years to arrive at the present value of the company. Knowing the total number of tokens outstanding helps the fundamental investor understand supply and demand. The management team is one of the most influential data points in the early life of a token. Have they had success in a similar venture before? Do they have an intimate knowledge of the industry the token focuses on? Do they have the professional network to widely influence the rate of adoption of the token? Has the team acquired early traction using scrappy growth hacking techniques? All of these concerns matter, and the white paper is a good place to begin your research on the management team. The cryptocurrency space has found use of a few quantitative methods, many of them used in traditional finance, for calculating value. We will cover these in depth in a future video. For now, we will just provide a brief overview of a couple. One key factor to remember before starting is that a model is only as good as its inputs. Many of the inputs are more subjective than objective, depending on the trader's own views of the market. An absolute valuation method calculates the total value of an asset using inputs specific to the asset itself. The method that some cryptocurrency investors are using is the equation of exchange monetary model. This macroeconomic model uses money supply, velocity of money, the price level, and an index of real expenditures. Moving the variables around to give a value for the money supply of a currency yields the equation M equals P Q divided by V, where M is the nominal money supply, V is the velocity of money or the rate of spending, P is the price level, and Q is an index of real expenditures. Relative valuation methods attempt to calculate an asset's value by using metrics to compare the asset to other assets. In the stock market, you might use metrics like price-to-earnings ratios, which we mentioned earlier. In the cryptocurrency world, there are a few other metrics to consider. The first method to consider is the network value to transactions ratio, or NVT. This metric looks at the cryptocurrency's market cap relative to its daily volume of on-chain transactions. The NVT allows traders to compare how the market values one unit of on-chain transactions per network. In theory, the lower the market to transaction value, the less the market is valuing the cryptocurrency. Another relative valuation method for cryptocurrencies is the number of transactions per second. In theory, the higher the number of transactions on a network, the higher its likelihood of widespread adoption. A high transaction speed increases the likelihood of, or even capacity for, mass consumer adoption. Now, I would be remiss if I didn't mention the forums and various cryptocurrency communities online that can provide current information to be used in fundamental analysis. Reddit has a countless number of forums and sub-communities focused on cryptocurrencies. Medium has more blogs focused on cryptocurrencies than I could even begin to count. As well, many of the currencies have Telegram, Discord, Riot, or Rocket Chat groups that you can join to stay abreast of any news that might affect the value of the cryptocurrency. There are two main trading styles of fundamental investors. Once you have looked at the available data and come up with your expectation of the actual value or intrinsic value of the currency today, your goal is simply to buy low and sell high. This typically means you implement a buy and hold strategy, or maybe you intend to buy the dip. Both strategies focus solely on buying because at the moment, traders cannot easily short the market. The buy and hold strategy is the ultimate long-term investing strategy. It assumes that the value of the cryptocurrency will be higher in the future, and therefore it's best to purchase today. Buy and hold investors will have to decide whether to make their full investment immediately at one price or to get on a steady buying program to build their position to the ideal size. One of the benefits of this strategy is that the investor is always focused on buying at the best price for maximum profits. That price is determined by the expected value of the currency. Buy and hold investors tend to have fewer transactions and thus less money spent on execution. They also have a long-term focus, which allows them to avoid the stress of momentary price dips. It all comes back to the value of the currency, not any white noise from price movement. This strategy also has some downsides as well. One of those is that you might miss the right opportunity to exit a cryptocurrency. Your expected value may be much higher than the market reaches. This will either lead to trading losses or holding a position much longer than initially planned. Another challenge with this strategy is the increased need for security. Holding on to your cryptocurrency is obviously very important. You will need to choose a wallet that suits your needs. It also helps to use a decentralized exchange, which allows you to remain in control of your cryptocurrency the entire time. The buy the dip strategy also assumes that the value of the cryptocurrency will be higher in the future. Investors that use this strategy ultimately show the market a full trust in their own valuation by purchasing the cryptocurrency when the market goes lower. This is an additional way to buy below the value created from your fundamental analysis. Buying the dip leads to adding to your position at a lower cost. This ultimately lowers your overall cost basis and hopefully increases your long-term profit in the currency. As long as the price goes back up or even returns to where it was, there's money to be made by purchasing when others are afraid. Warren Buffett is credited with saying, "Be greedy when others are fearful and fearful when others are greedy." The buy the dip strategy is the embodiment of that quote. Drops in price are not stress-inducing. They are opportunities to add to your position at a discount. As with most things in life, there are some negatives with this strategy too. In addition to the security issue we covered in the previous strategy, there's one more thing to consider. Sometimes the price is going down as an indication that something negative has occurred. The future expectation of the value might actually be lower than what you calculated, leading to a justified drop in price. Professional traders always warn against catching a falling knife. Consistently buying the dip might lead to a few cuts. Hopefully you have a better understanding of fundamental analysis. In the next video, we will continue this series by discussing technical analysis. If you're more prone to using historical price graphs to make trading decisions, this is right up your alley. We'll see you there.